Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Welcome to another episode of the What Matters podcast. I'm Mike Mershazadeh, and today joined by our distinguished guest, Jimmy Lee, the founder and CEO of the WCG Group, the Wealth Consulting Group, a trailblazing wealth management firm with remarkable national presence. In 2023, WCG was recognized in USA Today's Best Financial Advisory Firms and Financial Advisory Publications America Top RIA list. The financial media call on Jimmy for his knowledge in investing and the advisory industry. He appears regularly on CNBC, Fox Business, Yahoo Finance, and Bloomberg. He has been profiled and quoted in the Wall Street Journal, Market Watch, Financial Planning, Forbes, and many other financial publications. Welcome, Jimmy.
Hey, good to see you guys.
Your journey in wealth management is incredibly inspiring. To kick things off, let's explore your remarkable story. You've been self-employed since the very beginning of your career in 1995. Can you tell us more about your entrepreneurial journey since graduating college and the experiences that led you to founding the Wealth Consulting Group?
Yes. I started this career right out of college, and I got a job working at a firm that was owned by a large Fortune 100 insurance company that also owned the mutual fund company. And they had a retail, or still have a retail distribution arm where there were franchises. And so I was in a nice office in an office center here in Las Vegas, and with the sales manager and somebody that owned that franchise. And so I thought I was an employee, like a W-2 type employee, but I found out that at the end of the year, I owed more taxes than I thought I did, and received a good chunk of my income as a 1099 independent contractor. So I've been self-employed and really an entrepreneur since day one. But I got into management a few years into that career. There was a position in that firm that was there to called investment specialist, that was there to promote the sales and also supervise the compliance of the securities that we were selling and promoting. And so I was doing that as well, and promoting the sales of mutual funds and other investment type products. So I got into management a little bit early in my career, which was interesting because I was supervising people that were much older than me, of course. And that's how I started.
How did that work out in supervising people that were older than you?
Well, it was interesting, as a 20-something-year-old, being a registered principal and learning very quickly, the compliance side of our business, but also trying to promote sales, which is odd that I had both roles. Obviously, you can't do that today. And but it was neat because I had a lot of people in the office that were older with lots more experience that I could, not only was I supervising them, but I could ask them for advice and in areas that they could help me with. And so I thought it was a great start.
That's really cool.
Very cool.
I know in my start in my financial journey, and they made me into a manager supervising people that were older than me. It's a different industry. I was in the mortgage industry. They certainly did not want to listen to me. So
I'm not sure, Mike, anybody listened to me, but it was fun.
Well, you're a sought after expert in the financial media, appearing in CNBC, Fox Business, Yahoo Finance, and Bloomberg. Can you tell us about your journey into the media spotlight and how it's influenced your role in the industry?
Yes, Ashley. I was at a conference a long time ago. I think it was going back to maybe 2005 even. And I was watching a segment on stage where the advisor was doing a lot of media to promote his business. And I thought that would be an interesting way to build a brand or help expose the brand outside of my local market. So I hired that same PR firm, which is the same firm that I use today. And so I've been doing media interviews for a long time, over 12 or 13 years, I think, and maybe even before then. So I've been doing media for a long time, and it's been interesting to see the anchors age as well as myself, and do interviews over the years, and people changing from one, company to other as far as media companies. But I do believe it is a way to help advisors and or firms get their name out And while I don't ever think that clients are going to call up asking to invest money with us because of it, we've had a few of those occasions. It does help build some credibility with the industry, as well as with I still have a personal book of business, and that have advisors that work on my team that do most of that work. But it helps with referrals and also with recruiting because I'm in the business of recruiting advisors to our company.
So you're in business development as well for WCG?
Yes, I spend a lot of time, meeting advisors that might be a good fit for our firm. I'm involved in the recruiting process. While I don't lead that initiative anymore, I'm still very, very involved in it. So I go to conferences all the time and meet all sorts of different types of advisors with different platforms and backgrounds to see if, they might be good fits for what we can offer.
Really cool. So, you've been a very successful entrepreneur, and entrepreneurship comes up, and very often within its own lessons. And can you share a couple of the most valuable lessons you learned as an entrepreneur in wealth management? What advice would you offer to aspiring business leaders and entrepreneurs in the wealth management industry, given your experience in building and leading WCG?
Well, I would say not just for our industry, but for any industry, try to, as often as you can, always do the right thing. So I think listening to your intuition and your gut and not chasing money, which I've done before, I think that's great
Right.
advice. And really try to, identify what you love to do. I have a business coach. He calls it your genius. And, try to spend as much time doing that. And recently I read a quote that's hitting you guys in my pre-notes, and it said, if you hire people who are bigger than you are, then you become a company of giants. I love that quote because it is about having a great team, because you need to have a great team to be successful in this world in terms of business. And I've always thought that having smarter people, better people than me at certain areas of business is the way to go. It makes my job a lot easier. I can work less and be smarter, work smarter, excuse me, versus harder and more time. So I've learned that over the years.
I like that. So I take it you've fired yourself a couple times, and replaced somebody with more or better expertise in that space.
I think I have. I mean, I used to be a control freak early on in my career. And as the people that I work with would tell you, I don't micromanage at all. So usually if I'm calling them, it's not a good thing unless I'm just trying to get some information. We have regular meetings set up for, communicating well. I've got a great leadership team and a lot of qualified people that have lots of experience and good people that fit the culture of our firm. And so, I rely on them to do most of the heavy lifting for all the aspects of our company.
So I want to delve a little bit into the growth of your organization. Uh, Obviously, you've built quite a platform since you've been in business. And have you done it through organic, inorganic growth? Both? Can you give us some color on that?
Yes, it's mostly been all organic until we just did a recent merger with a firm that was, they're based in Kansas, and they merged in about a little north of $2 billion into our asset base. We're north of 7 billion now, and added some branch offices. And so, the business model that we have is a hybrid RIA firm where the majority of our advisors have a relationship with a broker dealer and an advisory relationship with our RIA. We have a second group of advisors that are only affiliated with the RIA. They don't have any FINRA registrations. And then I do have a small group of advisors that I am the OSJ for, which is typical in a branch type setting at a brokerage firm. So we have a small group of those advisors. And when we launched the RIA in 2014, late 2014 in October, we had about 30 or so advisors with 5 branches in the Southwest, and somewhere between $800 or $900 million of assets. And today we're up to over $7 billion, over 5 in the RIA with 44 branch offices,
Wow.
and I think 167 IARs. So we've grown a lot. Most of it, all that's been just organic.
Wow.
Wow.
So let me ask you this. You guys have you said 44 branches, is that correct?
That's correct, approximately.
and it's been one merger that you guys have done.
Mm-hmm.
So in when you say you don't micromanage and you work with very smart people, the first thing that popped into my head, having prior to being in private equity, I was in the mortgage space for 27 years. And, my twin brother and I, before we had sold our company, and Ashley was with us there as well, I think we had around 11 or 1,200 employees, which was an absolute nightmare, right? And one of the biggest challenges that you have in the mortgage space, well, obviously, would be barrier to entry because you need to be well capitalized. But uh, when individuals do get well capitalized, and we do hire, very intelligent people, the risk of them leaving our corporation and going and starting their own thing was pretty high, right? So obviously, letting them start their own DBA or joint venture underneath us was, something that we would entertain for the right person. Is that what you've done with the 44 branches, or how did that come about?
Yes, most of all of those branches are independently owned and operated by an advisor that is under our umbrella.
Gotcha.
So they're under our umbrella in one of those three channels: RI only, hybrid, or I'm the OSJ for that branch. But the clients are the advisor's clients. So we work with mostly independent advisors. We do have W-2 advisors in our firm, but they're typically working for an advisor team as a W-2 employee, financial advisor. And so the firms that are out there in my space where I compete, a lot of them that are much bigger than we are, with hundreds and hundreds of advisors and a lot more AUM, they really serve as a compliance overlay in many respects, meaning, since we're earning more fees on the advisory side than working with, let's say, a corporate, brokerage firm, they're able to pay more on the advisory. And a lot of those firms, that's what they do. They pay a little bit more. So they pay more compensation to the advisors and also provide compliance support. But that's it. And to me, those things are, big time commodities. And there's not a real relationship there. I think we stick out and I think it helps us with retention, is that the advisors that we work with, they use our services on a daily, weekly basis. So we serve as the back office for, very important parts of their offering, such as portfolio management, financial planning, maybe insurance brokerage, marketing, other things like that. And so we want to have a relationship with advisors that want a partner, a strategic partner like us, to be able to provide that type of a service. And where I think we've been able to stick out in the industry a little bit is that we provide a heck of a lot of services for the price point, meaning advisors can come to us and not feel any compensation difference if they were, on their own with an independent broker dealer, but get all of our support in addition to, what they could get normally with a normal independent broker dealer.
I like that. No. So you're, I take it a lot in like us in the sense that when you partner with these individual branches, you're a tool and more of a growth channel for them. They come to you guys if they need, the obvious accounting, marketing, things like that. Let's just say that they want to, do any mergers or acquisitions. They want to hire financial advisors and whatnot. Do you run them on a P&L, or how does that work with all 44 different companies there?
So we have a handful of branches. When we first started, the 5 branches were, on a grid of some sort and not acting as independent branches, where I was the person who was backstopping, like, for example, the lease and the real estate and maybe the labor support, the people that supported their branches. We don't have as many of those anymore. We still have some for advisors that are breakaway from wirehouses or other settings where they don't want to deal with the real estate or fully be an entrepreneur 100%. But most of those branches are independent branches already. So most of the advisors that we have today came from an independent environment, but they need support. And so the platform of services that I had created before creating the RIA was really something that I found after setting up the RIA that a lot of independent advisors need and want. So I thought we were going to grow by acquisition, a lot of inorganic growth. And what I found instead was that there were more advisors out there doing business on their own as a solo practitioner or a smaller team. And while they may be with a large broker dealer, they feel a little bit lonely, and they're having to do all the heavy lifting on their own in terms of, providing the services to their clients. And so we were able to create some solutions, I think, that are somewhat unique in terms of how we priced it and how we can help the advisor. And that's helped with retention and the long-term aspect of the relationship that advisors can have with us.
I really like that. And I ask because, when after this podcast ends, and we go take it offline, I have a really hot lead that is looking for exactly that. These guys are with Merrill Lynch right now, and they can't seem to put it together to start their own thing. And exactly what you're saying is, I think, is exactly what they're looking for. But we'll take that offline. Thank you for clarifying.
Thanks.
Yeah, so building, a successful firm of over 7 billion in assets, really requires that innovation and strategy. Was it in 2016 I saw that you were named the 5th fastest growing RIA by the Financial Advisor publication? What do you think are some of those key strategies or decisions that contribute to that impressive growth? Do you think it's this, unique hybrid model that you created, or any other strategies that you would really give credit to your firm's growth?
So I would say it's all centered around creating more billable hours for the advisor that wants to grow. And what I mean by that is advisors spend a heck of a lot of time doing things that are not revenue generating. And we can get into that more in detail. But all of our services that we provide to the advisors that work with us is to help them create more billable hours, spend more time on revenue generating activities versus non. And that's evolved. But I would say that that's where we spend all of our time thinking about what can we do next to help increase the value proposition for the support services that we provide, so that it is the best in the industry. I don't think the hybrid model is unique, although I will say that there are a lot of advisors in different channels like Wirehouse that don't understand what the opportunities are with different types of intermediaries like us out there. And so what I saw before setting up the RIA and why we decided to create the model that we have was just with the, kind of a blank canvas. I was thinking about what would be the best structure for the independent financial advisor out there. And I started drawing boxes, and one of the boxes was an RIA, another one was broker dealer, another one was an insurance agency, and then another huge box with a lot of other concierge type services. And so all of that being integrated is what we ended up creating. And so again, it's all about helping the advisor create more revenue generating time so that they can, focus on doing that and working with their clients versus things that don't earn them the kind of money that they want to earn if they're looking to grow. So that's part of it. And I know that you guys talked about innovation. I worked for decades with companies that were attached to large companies with vast resources when it came to people and money. And I saw those companies trying to compete in technology, trying to, create their own tech for whatever it was, whether it was performance reporting or trading or whatever the heck you're talking about. I'm sorry, different things. And, they were always behind on deadlines, even though they spent a lot of money and had a lot of people. And, those companies are just not tech companies. So by the time they rolled something out, it was late, not that great, and it was already stale. And so I decided myself, and my background's not tech, that I'd rather be an early adopter of great tech that I thought would gain market share versus trying to be innovative, myself personally. That's not my background in creating new technology. Although there is something that I'm working on a little bit that is a tech platform. But I wouldn't do it if there was already a product out there, that we could access. So yeah, it's all been about trying to help the advisor grow. And what I think's happened more recently is that, the private equity space, Mike, and Ashley, has really impacted valuations. And so it's created some interesting opportunities for advisors to team up or sell some of their equity or all of it. And I think that we're going to see that really ramping up, because while the M&A activity has been very busy and active over the last 5 years, I think it's really been more at the platform or firm level and not so much at the advisor level, just because of demographics. Right. And so I think it's really going to heat up in the next 5 years.
And to highlight on that, what do you think your guys' where do you think you guys are going to go with your growth from here?
Well, you know, I hope that we get to continue to grow the way that we have been. Our top line revenues, we've been growing at 30% a year since we started.
Wow.
And again, that's been all organic growth, really. And so, building on our bigger base, even if unless we do a lot of M&A type activities, I still think we can grow at a pretty healthy pace. But certainly M&A type activities will or can make that growth even faster. But I think now our focus is to focus inward, really, even though there's a lot of, I get an email a week from a new private equity firm or somebody that's trying to sell us or buy us or merge
Right.
us or whatever. And I know that's the business that you guys are in too, but we want to provide even more services and better services to the advisors that we have. And we want to also provide succession planning for them at a better, in a better way than we ever have. And so because of the demographic of advisors, I think firms like ours have to focus on business succession planning for their advisors or M&A just as a defense, just playing defense so that advisors don't go somewhere else. And then if you turn that into more of an offensive strategy, as many firms have done, then you may have a whole bunch of advisors out there doing M&A for you without you having to do it yourself and growing the firm that way. I know a lot of firms that have been good at doing that and working with their advisors and supporting them. That's been a part of their success story too. So we'll be focusing more on that as well.
Really cool. And let me ask you this: with having the the new merger and the 44 different branches that you have there, does each different branch and does the new company that you guys merge with, do they have different investment strategies? Or do you guys have like a core like a core group or core center of investments that you guys all meet up on and talk about? What are the rules there, if you don't mind me asking?
Yeah, that's a big part of the culture of our firm. Again, I said that we really want to work with advisors that want to use us as a strategic partner for those things. So the portfolio management part of our firm is a big part of our economics and is important. And so if an advisor is really not open to letting us run some of their money or all of it, they're really not a great fit for us. So while we don't have all the advisors that work with us, all of their money in our models, we have a large chunk of the advisors that we work with portfolios in our models, and we think we do a darn good job of that. Another piece that is difficult for an independent advisor is to create good tax efficient portfolios for larger accounts, and I'm not talking about multi-million-dollar accounts, but even north of a few $100,000 in an independent space. To access separate accounts, SMAs or UMAs, it's very expensive. So advisors typically don't do that very often, only when they need to, and they run their own models. And maybe it's tax efficient through ETFs, but that's, it's not like having individual stocks, for example. So we've created some solutions that include, SMA, UMA type strategies that at a very low price point, that's way less than what they can access in a third party platform or their broker dealer. And so that's been a big part of winning business too. Advisors can come to our firm, lower the cost for their clients, at the same time possibly increase their own revenue. So with our portfolio management, we also provide other services. And I know there are firms out there that do what we do, obviously charging a fee for, money management. But along with that, what I think is very unique is advisors really struggle with providing consistent financial planning to their clients. I mean, a lot of them will do it up front to engage a client and get them to work with them, but then maybe not do as good of a job after that, keeping up with the financial planning. So we have paraplanners and CFPs. We even have one that's a CPA, and we provide that service for our advisors for almost free. It really is a nominal fee that we take when our advisors are doing planning for their clients, whether, if the client is paying a fee to the advisor for the plan, they still get the majority, almost all of the fee, and we're doing almost all the work. And it's not just inputting data. Even our staff will work with the clients to connect accounts for the account aggregation, for example. Sometimes our CFPs are actually presenting the plan so that the advisor can position themselves as like the financial quarterback, or what we call personal CFO. All over our website and our marketing material, we try to help our advisors position themselves as personal CFOs rather than just an advisor, and try to help coach them with language about all the things that a great advisor does that they don't get paid for, and in making sure that the client understand that that's not a typical service that every advisor can provide, or provides. And so the financial planning side that we offer for clients, even if an investor is not paying a fee to the advisor, for clients that generate enough revenue to the RIA, we still help them with all the financial planning back office stuff without charging them a big fee for that. So we're very unique there. And I think that's been a philosophy of mine, that I want a firm where the advisors are working with their clients on a consultative basis versus transactional. So those are the people that we attract. We attract advisors that want to do planning if they're not doing a lot of planning, and we help them execute.
Really cool.
Okay.
Have you ever had to let go of any advisors for not for going against what you guys are trying to do there?
Well, ultimately what happens, Mike, and this happens from time to time, advisors may say one thing in terms of what they're open to using or not when we recruit them.
Right.
And then it could be our fault. If we don't do a good job of helping the advisors, use our services, or, utilize what we can help them with, then ultimately it's not a great fit. And we end up getting divorced at some point, And so it's better really to do all the fact finding up front and the due diligence to make sure it is a good cultural fit, because we study advisors and how often they interact with our departments. And consistently, the ones that grow the fastest are the ones that are leveraging us the most.
Utilizing the
portfolio
resources.
management. It just makes sense.
Yeah.
They have more billable hours. They have a desire to grow. And if you think about it, in our industry, a person that's generating $1 million of revenue as an advisor, let's say $100 million of assets, that's considered a successful person, right? In terms of our space. And the typical staff makeup of that independent advisor will look like maybe 2 people, roughly, of which 1.5 of those people's time, maybe one employee and half of another employee's time, is spent doing admin work, and then maybe the other half of one employee is helping with marketing efforts. And they're not CFPs typically that advisors at that level will employ, or CFAs. And so if they're going to be managing money or doing financial planning, they do have to do a lot of that themselves. And as you know, a lot of independent advisors will start using third-party asset management programs, but as people get experience, and we all think we're Warren Buffett out there, we manage our own money, or try to. And at the same time, we want to take a lot of time off. And a lot of advisors that we recruit that are older, in their 50s or older, have lifestyle practices that, where they spend a lot of time on enjoying the fruits of their labor from the first 30 years or something. And so, but most advisors that we talk to that are experienced, they understand that equation, and they want to provide their clients great portfolio management and good financial planning. And so I think we're attractive to a lot of people.
I like that.
And roughly how many advisors, you might have already mentioned this, but how many roughly advisors do you have?
We have 167 advisors that are attached to the RIA, but some of those are employees for other teams and stuff, and they may not all be client facing.
Gotcha. So those are the independent advisors, but with a few W-2 mixed in there.
Yeah. I would say there's a good handful of W-2 advisors that work with senior advisor teams.
Okay. Wow. Well, that's quite the team you have there. Shifting gears a bit, Jimmy, with your expertise, what are your thoughts on the future of wealth management? Are there any trends or technologies that you see shifting the industry and you anticipate shaping its trajectory?
Well, I definitely think that we're going to continue to see consolidation. And at the firm level, I don't believe that there are only going to be a handful of companies around in 10 years, though. A lot of people have written about. I still believe there's a place for the sole proprietor that has a good business and intimate relationships with their clients. But I do see a lot of advisors aging out and wanting to not go through another bear market. And they're, they know that valuations are the highest they've ever been. And so even advisors that don't have huge practices, I think, are going to be looking to set up formal succession plans like literally as we speak. And so while some people who have not been in the M&A business really think they might have missed the boat, I don't think so. I think we're in the early stages of advisors really getting out of the business and wanting to start some sort of a strategy so that they can be completely done within 2 to 5 years. So I think we're going to continue to see that trend. We're going to see technology continue to evolve. It'll be interesting to see how AI impacts our space. But until the day that, somebody doesn't panic or get concerned when their account statement comes in and it's down 30, 40%, I think humans will still be in business. So hopefully what AI will do will be just to help make our businesses more efficient, profitable, provide more timely services, automated services to the end investor client. And the companies that provide the CRMs and portfolio management, the custodians, all of those entities and channels, I think, can really impact what the end user experience will look like. So hopefully that'll be better too and easier for the advisor to execute.
Yeah, I like that you got into AI there. One thing I was going to bring up was on our last podcast yesterday, our guest had brought up about people that make money. They think that they can invest it properly, right? And I can tell you, I've always been someone who since I was a child, money's always came easy to me. I've always worked hard and always figured out smarter, better, and easier ways to make it. And I can tell you this: when I had sold my interest in the mortgage bank that my twin brother and I had with a couple of other gentlemen, I had ran into a nice sum of money, and I fortunately gave about 70% of it to my financial advisor, and the 30% of it that I kept for myself was just an absolute nightmare. So I mean, I'll tell you this, because it was, you kind of learn that the locker room talk is full of shit. You also learn another thing there, that by the time people will tell you, my Uber driver told me that you should invest in this, and it's like, and by the time it got to all that, I was like, hey, listen, I've lost as much as I can lose. Most of my losses came from probably options, I'm guessing. I don't really like to think about that time, but can you when going, I wanted to bring that up for a specific reason, in saying that I feel that most people can benefit from having a financial advisor. I would say 95 out of 100 people can benefit by having a financial advisor. What would you guys say that you do differently than the big wirehouses? Obviously,
talking about that, what the industry is going to look like going forward, I think that what's great is, when I started, you were either an advisor, which meant you had to bring in clients, which meant you were a salesperson, or you're an assistant. That was it. Now we have all sorts of different roles within firms. So firms like ours have gotten bigger. So it's not just large institutions and, solo practitioner anymore. There are lots of in-betweens. And so it's fascinating that the wirehouses continue to be like they were before, except it's just more fee-based now, meaning that those channels really focus on just the money management side, and that's really it. But I think we're going to see a lot of change going forward, because in the next 20 to 30 years, the money is going to be changing hands from, people that we're all accustomed to working with, which are baby boomers or older, that had the money, to now their children. And I've always been a big proponent that I wanted somebody live to answer the phone calls to the offices. But now we're going to be dealing with people that don't want to talk to anybody. And so I think it's very important to pay attention and get ahead of that, to make sure that you're interacting with your client, or who's going to be your client, the way they want to be interacted with, and be very responsive. And so I think that's going to be a big part of the success strategy for people that are going to be really taking advantage of getting the wallet share of their clients, families, investment opportunities, and everything else. And so besides that, I think that the industry is going to continue to evolve, and where I see the advisor of the future looks more to me like someone who has maybe gravitated from some sort of an employee type structure, like wirehouse or insurance company BD or something like that, to maybe some sort of a independent model, maybe hybrid, then to RA only. I think most advisors that have bigger businesses will retire without any FIN registrations. So the key is then how do you help them get there without a lot of disruption? And that's the model that we've created. That's where I think the puck is headed. So when we set up the RIA, the hybrid space was what I could see as the fastest growing, channel within our industry. Now I think, the RIA only channel is growing faster. And I think we're going to continue to see that happening.
Really
so
cool.
Being prepared for that and having a platform to allow advisors to get there, I think would be important for firms like ours to focus on.
Really cool. And let me ask you this, obviously you brought this up a little bit earlier, talking about what happened in 2022. Again, that was another, that was another one of my not so proud moments when, my financial advisor would call me and I say, don't tell me how much is in my account until it's back up to the amount that I originally invested with you. Right. Because last year was just an absolute bloodbath. And with this year being a bit of a rebound, you had said that the market seems a little hot, maybe inflated. Some stocks and some sectors do. What do you think is going to, in your opinion, and you can answer this or choose not to, what do you think is going to take place with the market? Obviously, with interest rates being where they're at, the debt ceiling where it's at, a lot of interesting events have taken place already that we haven't seen, what the outcome's going to look like. What's your opinion?
Well, before I answer that, I want to talk about the typical investor and advisor and where I see some issues. And then we'll get to the markets and economy here because it's as a lead into it. First of all, it's fascinating to me how many times I will talk to an investor who has millions of dollars and has been investing in stocks and mutual funds and ETFs for sometimes decades. Okay. And they do not, if you ask them, what is a stock or a bond or a mutual fund or an exchange traded fund, they wouldn't be able to tell you. So no wonder people panic when their accounts go down because they don't understand what they own. Couple that with financial advisors who think they're hedge fund managers or can time the market properly, then you have two parts of a problem, making it even bigger. So the advisor is not the solution, maybe even creating more confusion for the end investor. And so I think that's creates a lot of opportunity for financial advisors to really, inform and educate the people out there that are going to become their clients. And also for advisors to really think about their philosophy and what they're doing for their clients and how they're managing money. So with that being said, I think that in the near term, it's interesting, right? Because you were saying in 2022 was a horrible year. Well, this year, a lot of people, including institutions, put a lot of money into like one of the biggest sucker bets that I've seen in a long time, which is to put it into a 4 or 5% money market or treasury. It sounds very attractive.
Elaborate on that, please.
Yeah. Well, everybody was expecting a recession, which hasn't happened. And, the markets are up a lot.
Yeah.
But unfortunately, a lot of people have missed out on it. And so trying to time the market, it's just very difficult to do consistently. And I think advisors that are doing that are confusing their clients even more and just creating more, bad results for their clients in the industry. So I think advisors especially should really rethink how they're approaching, the concept of market timing or trying to get in and out and really figure out, and I know the best advisors, I don't think really do that. But this year, I know that we've all been challenged with idea of, look, if the market's or if the economy is going to go into recession and we're going to get this big correction that people are expecting because of it, then should we hide out in treasuries? And that's been an easy thing to do, to fall into that trap. And you would have missed out on, all the recovery that you needed to recover from 2022.
Right. I held in there and, recently, diversified into fixed income. And it makes me feel good that you said that, right? Because, going into the future of where the economy is heading, if we do head into recession, obviously it's been, in the past, interest rates go down. Do you think interest rates go down, more money goes in the stock market? Because the stock market is not necessarily the economy. What are your thoughts there?
So, my base case has been, and since I do a lot of media, you can go look at interviews all year long. I thought that the consumer was going to stay strong, that we were not going to go into a recession. So a lot of economists that were predicting the recession have changed their tune, and now they're saying that they were wrong. But some of them still are just pushing it out till next year and saying that we're going to get a big correction next year. I just don't see that materializing. I think what could happen is this: if the Fed's done raising rates, which is very likely that they're done, then I can see another run in equities before year end. I could see interest sensitive sectors like tech or high growth, real estate, other sectors like that benefiting, long dated bonds. So we were actually on our investment committee this morning, and we're discussing about how to add duration to our fixed income portfolios right now, and to try to take advantage of what we think will happen over the next cycle, which is lower rates. So if that happens, I could see potentially a market correction if we get, even more expensive market next year. But that's not because I think the economy is going to fall apart. And whether we go into recession or not, I don't think it matters, because nobody's predicting that there's going to be massive unemployment or a bad recession. Most people think that we're just going to go through a technical one. So we'll probably have some sort of a soft landing. But I think it is important to be diversified. And one of the areas I see opportunities where a lot of people are fearing what may happen in commercial real estate, I think for savvy real estate investors, there's a lot of opportunity there. I think there are opportunities in things like private credit, yields that we just haven't, seen like ever in my career, in private credit and equity. And this is for people that have fresh capital to invest, not in older vintage type products. So I think those are the different areas that provide a lot of opportunity that's not typical.
Thank you. I appreciate that. That's very informative. I like that. What do you think is going to be out of curiosity, what do you think is going to happen with residential real estate?
Residential? Not much. I think hopefully rates will come back down and people will sell their houses so they can buy another house that's similar in size versus having a downsize because the payments are so high because of higher rates. So I think that's what's going to happen. I think you've seen the home builders benefiting from that.
Right.
And so I think, hopefully that'll create a better balance between supply and demand. So I don't see any sort of a crash or anything residential.
Yeah, I'll agree with you there. I think that so many people got, this isn't the 2002 to 2007, subprime, market boom there. Obviously, property values went up quickly, from 2019 to 2021. And, we're seeing some correction there. But we're also so many people didn't take out adjustable rate interest, interest only adjustables, tied to LIBOR and coffee and Covey and other indexes. We're talking about a bunch of people that took advantage of 2.5% 30-year fixed rates. And I think no matter what really happens to their lives or their property values, they're not going to get rid of that anytime soon.
No, but I do know that there are a lot of people out there that purchased homes in the mountains and on golf courses and stuff that, after a couple of summers, they may not be the mountain person that they thought they were. So right. I think we will see a correction in some of those areas, but people will walk away from a little bit of the equity probably in some of those hot areas like that. But anyway, I think the economy is going to be okay.
Yeah, we're seeing that here in Arizona. I think, I've seen on the higher end homes, $3 million homes going for 2.1 to 2.3. $10 million homes going for that 6.5 or 7. You've seen some of that going on. I agree with you. Thank you.
And I just have one more question to close us out. Based on your expertise, Jimmy, what can people do what's your advice for what people can do to make, informed financial decisions right now?
Well, first of all, thank you for having me on your show and saying nice things about me. I really think I'm very lucky and very grateful for the position I'm in and the firm that we have. And as far as, markets and opportunities for the future, I think that investors should really go back to just the basics of planning, really hone in on and have clarity around what your financial goals are and objectives, and make sure you have a plan that can help you achieve those goals with the highest degree of probability. And I would make sure that they have really good communication with their advisors and that they're working with advisors that are proactive with their clients around those subjects. And so I really think there's an opportunity for financial advisors to step up our games in terms of servicing clients and making sure that they feel good about their money and their financial goals. And so I just think that as firms consolidate and as the industry consolidates, what you could get is a better result from the client experience, because the clients, especially with the independent space, clients can get a different experience advisor by advisor. And I think that the whole level of service is going to go up because of the consolidation, though. I really do.
Well, thank you, Jimmy. Your journey and your insights have been very enlightening and inspiring today. Thank you for joining us on this episode of the What Matters podcast. We really appreciate your time today.
Thank you, guys. Nice to meet you.
Thank you. And to our listeners, thanks for tuning in to another episode of the What Matters podcast. Stay curious, stay informed, and join us next time as we continue to explore the exciting world of wealth management and financial innovation. Thanks, everyone.